If you've spent literally any time on financial social media lately, you've probably been absolutely bombarded by ads for AI trading bots, the ones promising guaranteed get rich quick returns. Well, today we're going to completely strip away that illusion because the reality of institutional quantitative trading is far more complex, mathematically rigorous, and frankly, a lot more fascinating than just buying some plug and play script. Let's dive right into this explainer and uncover the massive hidden infrastructure underneath it all.
And we really need to start with a massive reality check. As one of our sources points out so perfectly, real quant trading is not about finding one magical indicator. It's an engineering discipline. I mean, most people get this entirely backward, right? They hunt for a clever strategy first and completely ignore the risk models and the realistic backtesting you actually need to survive in the markets. Real success? It means abandoning that search for a single clever idea and building a system layer by layer.
All right, let's move into section 1, the reality of quant trading.
Think of an AI trading bot as just the shiny tip of the iceberg. What's underneath the water is what actually separates the hobbyist from the serious quant. The hobbyist is out there playing with spreadsheets, guessing at patterns, kind of just reacting emotionally to market noise. But the professional, they are building a massive submerged foundation of data engineering. They take a core idea, say momentum or mean reversion, translate it into strict mathematical rules, and build a systematic, disciplined process from the ground up.
Because before any system can actually think, it has to be fed. And we aren't just talking about your standard historical stock prices here. We're talking about massive amounts of alternative data, satellite imagery tracking commodity storage, credit card receipts, the whole shebang. Institutions filter all of this through a Delta Lake architecture. It's almost like a giant water purification system. First, the bronze layer ingests the raw, murky data. Then, the silver layer cleans it up, sanitizing timestamps, stripping out personal info. Finally, the gold layer structures it into pristine feature stores, making it perfectly ready for the AI to drink.
Which brings us to section 2, brains, AI, and machine learning.
So this is where we level up from basic rules to highly adaptive, data-driven brains. But how do these algorithms actually categorize the world? Well, in supervised learning for quant forecasting, it basically boils down to two main tasks. First, you have regression models. These are used to forecast continuous variables, so predicting the exact dollar amount a price will change, or forecasting future volatility. Classification models, on the other hand, they draw a hard line in the sand. They generate distinct, categorical signals, essentially telling the system to definitively buy, sell, or hold.
Now, taking it a step further, and this is where it gets really wild, deep reinforcement learning acts as a fully autonomous agent. Instead of just predicting a price, it treats the market like a complex video game, what we call a Markov decision process. The AI agent observes the board, takes an action, like dynamically sizing a long or short position, and then it gets a mathematical score or reward based on its portfolio returns. Through endless trial and error in simulated environments, it literally teaches itself the winning strategy.
All right, moving on to section 3, brawn, ultra-low latency architecture.
Because let's face it, all those brains, totally useless without the physical brawn to execute trades in a fraction of a heartbeat. The sheer complexity of a professional execution pipeline is mind-blowing. It securely isolates the signal generation from the actual order routing. So, market data flows into an adapter, hits the AI brain, which is the complex event processing engine. But wait, it doesn't just fire off a trade right away. That signal must pass through a strict risk management system to make sure the AI hasn't gone completely rogue. Only after that does an order manager format and transmit the trade to the exchange. Now, to put that speed into perspective, institutional ultra-low latency direct market access requires a total round-trip processing time of 500 microseconds or less. 500 microseconds. That is literally half of a single millisecond. The entire pipeline we just talked about, ingesting the data, running the AI models, passing the risk checks, and executing the trade happens faster than human comprehension. To actually win this game, firms have to beat the physical speed limits of fiber optic glass itself. How? They use colocation. That means physically bolting their servers inside the exact same data center as the exchange's matching engine, just to shorten the actual wire distance. And at the software level, they use kernel bypass technologies, like single-root I/O virtualization. This routes network packets straight into the application's memory, completely skipping the standard operating system delays. Down at this level, every single microsecond is a battleground. Let's pivot to section 4, fatal traps in backtesting. You know that very specific kind of optimism that only a backtest can produce? where your equity curve goes beautifully up and to the right until you trade it with real money and it immediately collapses. Well, these 6 backtesting traps all share one root cause. They systemically trick you into thinking your historical returns are pristine. They never make a strategy look worse, they only flatter your ego, and that is exactly what makes them so lethal. Let's look a bit closer at a few of the deadliest ones. Probably the absolute deadliest trap is look-ahead bias. This basically gives your backtested strategy a time machine to peek at future data. So for example, if a company revises its second quarter earnings in September, but your simulation uses that revised number to make a trade back in August, well, yeah, your AI looks like a psychic. But in the real world, that information literally did not exist yet. Then you've got survivorship bias. This is where your model falsely looks like a genius because your dataset conveniently wiped out all the losers. Say you test a strategy on today's S&P 500 over the last 10 years. You are totally ignoring the companies that went bankrupt and fell out of the index during that decade. Your backtest sidesteps those massive losses entirely by accident. And, of course, overfitting. It's like memorizing the answers to a practice test, but totally failing the actual exam. You tune your model so perfectly to historical noise that its performance just falls right off a cliff when it's confronted with fresh data. If tweaking your moving average window by just 2 days causes your entire strategy to collapse, you haven't found a robust financial signal, you've just found a mathematical coincidence in the past. Okay, moving into our final part, Section 5, Managing Risk and Drift. Because markets are, well, notoriously unstable, professionals have to build mathematical shields against the chaos. They use metrics like the Population Stability Index to track what's called model drift. That's the exact moment a model's predictive power starts decaying because the live market data no longer matches its training data. They even deploy hidden Markov models to detect invisible regime shifts, like realizing the market just abruptly transitioned from a calm bull run into a highly volatile bear market, and then automatically adjust the system's risk profile. You also have to layer on extreme risk controls right at the execution level. Real pros don't just rely on a single defensive measure. They use the Kelly criterion for mathematical sizing and dynamically adjust their position sizes based on current market volatility using the average true range. But most importantly, they build system-level kill switches. If an algorithm experiences a rapid sequence of failures or volatility spikes insanely high, the automated circuit breaker slams the brakes and shuts the trading down instantly. No destructive revenge trading allowed. And we can't forget this whole massive infrastructure exists in the real world, which means heavy regulatory compliance. Governments fully recognize the power and the extreme potential danger of AI trading. Frameworks like FINRA in the US and MiFID II in Europe demand hard pre-trade capital checks, continuous annual stress tests, and strict algorithmic transparency. You absolutely cannot just let a black box neural network run wild. So I want to leave you with this final provocative thought to chew on for today's explainer. The next time you see an ad for a supposedly flawless AI trading bot, ask yourself, are you looking at a rigorously tested, latency-optimized, mathematically sound system, or are you just looking at an overfitted algorithm that successfully predicted the past but is completely doomed in the future? Real quantitative trading is a phenomenal, powerful discipline for sure, but only if you respect the immense complexity beneath the surface. Thanks so much for joining me, and as always, keep questioning the data.